Welcome to Investors Insights. Our topic today is 90%. 90%. Why is that important to us? We're going to explain that in this vlog. I'm joined by my distinguished colleagues, Bobby Norman, Trey Booth, Ty Miller, and Adam Van Zandt. We've just finished up a great portfolio strategies meeting, and we're going to continue the dialogue of this meeting and this vlog as the week progresses in terms of our social media, LinkedIn, Twitter, Facebook, YouTube, and our podcast. Also, we have a new Innovation Mavericks podcast session out on Five Plan Partners podcast, and encourage you to listen to it. Great interview with Mitch York and talking about EOS. You'll find it fascinating. That said, I want to go straight to Bobby because, Bobby, you're the reason we picked the topic today, 90%. Talk about that.
Yeah, so there are a lot of questions being asked about if the market strength seen the past few weeks is sustainable, or if what we've seen is a typical bear market rally. And 2 weeks ago in the vlog, I talked about one thing we look at in looking at market strength, and is what percentage of stocks are above their 50-day moving average. And 2 weeks ago, only 68% of stocks were above their 50-day moving average. However, after last week's rally, and as you can see in this chart here, the percent of stocks trading above their respective 50-day moving average broke through the important 90% threshold on Friday. And that's marking the best reading since April of last year. So the persistence and the breadth of momentum, which is the indicator here attempts to measure, is a welcome change from the prior rally attempts that failed earlier this year. But as strength is strong here, but the market still has some near-term hurdles to contend with. So many of the indices are now overbought. Seasonality doesn't offer much help here over the next coming weeks. And the downward sloping 200-day moving average is still above the S&P and the NASDAQ. So momentum is strong, but we still need to get through some things in the near term. And Adam will give specific technical numbers at the end.
Yeah, Bobby, you have talked this year throughout the vlog for people to continue focusing on earnings, and appreciate that, the way you've stuck with that. And then the other topic that's big is inflation. We hear that from our clients on a regular basis. And Trey, you've really done some extensive research on inflation and the indicators that we're seeing. So talk about that in relation to what Bobby's saying.
Yeah, absolutely. Thanks, Greg. So inflation is definitely top of mind for everybody, the consumer, the individual. Everyone sees it on a day-to-day basis when you go to the grocery store or fill up your tank. But the way we're looking at it is more on how it impacts the markets. And directly how inflation impacts the market is it impacts what the Federal Reserve does. And the Federal Reserve, having a $9 trillion balance sheet, is the biggest mover in the markets right now and for the foreseeable future. It was great news last week that we got that inflation had fallen from 9.1% down to 8.5% year over year. Now, 8.5 is definitely still high, but you've got to peak and roll over before you can come down. And so what does that mean for the Fed? If you look back since 1970, the Federal Reserve has raised rates continuously until their federal funds rate is higher than the rate of inflation. Now, if you say the federal funds rate, which currently sits at 2.5%, needs to go to 9% to quill inflation, well, that would be very disruptive. So what we need to see inflation come down while the federal funds rate goes up. You can look at this chart. It shows every rate hiking cycle has ended with the federal funds rate being higher than the inflation rate. So both need to happen. We need inflation to continue to come down, but we would expect the Federal Reserve to continue to raise rates into that number. And so where they meet in the middle, that's the biggest question for the market. How far down the road the market is expecting it is really what drives the current rally. And we may be getting a little out over our skis, per what Bobby was saying. We may be a little overbought buying into a inflation relief rally. Peak inflation does not mean peak interest rates, but something we're watching very closely.
Yeah, well said. And Ty, in the meeting this morning, one of the things we always like to emphasize, we bring up topics just like Bobby and Trey have already done that possibly the media is not picking up on, or we want to make people aware of the fact of things that we're looking at and the pieces of the puzzle to navigate through this market. And you brought up about buybacks. Explain that. Go into a little detail here for our viewers.
Yeah, so with the passage of the Inflation Reduction Act recently, one of the lesser known clauses in there is a 1% buyback tax. People didn't really know when it was going to start. Well, we got that answer. It's going to start January 1st, 2023. So the good news about tax policy is it's a one-time change. Companies can kind of plan for that ahead of time and they have a little bit of advance notice. So, we might see a pulling forward of additional buybacks. It's one way for companies to return, cash to shareholders. The companies buy back their own stock. That might be something that we see here at the end of the year. It could be kind of a catalyst for the end of the year if companies are buying back excess stock. And then another change that could possibly happen after January 1st is maybe we see more dividend increases as opposed to the buybacks because of the tax policy change.
We always like those dividend increases. There is no doubt about that, and some good buybacks when a company thinks the best way to use their cash is buy their own stock back. That's always great to see as well. So good insight there, Ty. And Adam, we're coming to you now. We've got all this data, fundamental information. On the technical side, what kind of market movements are we looking at?
Absolutely, Greg. And we saw a good bit of momentum in the overall markets last week with 11 sectors finishing in the green on both Wednesday and Friday's trading day, with the S&P close on Friday at 4,280, giving us a new resistance level of 4,310. Also a new support level of 4,250. Late spring, early summer, we also talked about the 4,200 mark. We've now crossed over that. And now the one that we're actually testing, back to Bobby's point, is that 200-day S&P moving day average that's currently sitting at 4,328. So we'll see if this momentum can continue through the fall, and we'll see if we can get back over that 200-day moving average. That's a really important indicator for the markets.
Yeah, there's a lot of activity going on, folks, and we're going to keep you updated. We hope you found this vlog very beneficial, and we'll continue to update you throughout the week. Please know each and every day that we walk through the doors of Five Plan Partners. We're striving to make our clients' lives better, richer, fuller, and we hope you have a great week. And just know this year is moving fast, and we're going to continue to keep you informed. Take care.